Okay, this is the second video for the rest of chapter 16 for the in-class assignment. Here we are looking at tax expense and how a change in tax rates can impact the balance in our deferred tax liability or asset. So we have Cell Image Corp. They reported a deferred tax liability, so that would be a credit balance of $120,000. This was caused by equipment with a UCC, so that is our tax basis of $1.5 million, and that asset had a net book value of $1,980,000. We had a tax rate of 25%. And in 20X6, we had accounting earnings of $350,000. Depreciation expense was $150,000 and CCA was $200,000, and the tax rate is now 35%. And we need to calculate our tax payable, the tax basis of the equipment, accounting basis, deferred income tax adjustment, and then we need to look at that adjustment and see how much of it was caused by the change in the tax rate and how much is the new temporary difference, and then calculate our tax expense for the year. So the first thing we want to do in calculating the tax payable is to figure out what our taxable income is versus our net income for accounting purposes. So our accounting earnings were $350,000. We know that we want to add back our accounting depreciation expense, and then we want to deduct our CCA for the year. When we do that, so $350,000 plus our depreciation expense minus our CCA gives us a taxable income of $300,000 for the year, multiplied by our 35% tax rate is going to give us income tax payable of $105,000. So now we want to look at the temporary difference and the deferred tax asset or liability that results from that. So shelving this for a minute. Our equipment had a UCC, okay, so for tax purposes of $1.5 million, but we know that we took $200,000 CCA from that, so our tax basis is going to be 1.3. Our accounting basis, it had a net book value of 1.98. We took $150,000 in depreciation expense, which gives us an accounting basis of 1.83. A temporary difference of $530,000 multiplied by our 35% tax rate. We know that we had an opening balance of $120,000, again, a credit, so in parentheses, which means that the adjustment we need to make is going to be $65,500. Okay, so that is still a liability. It is a credit balance. So now we want to look at how much of this relates to the temporary difference between our depreciation expense and CCA, and how much of this relates to the difference between the change in tax rate. So in order to figure this out, to look at the change in the tax rate, we want to look at the difference between our net book value and our UCC, and we want to multiply that by the difference in our tax rate. So when we do that, we are going to get a difference of $48,000. And again, this is a liability represented in parentheses. That's why I have my net book value ahead of my UCC, so that when we multiply by the negative change in the tax rate, it shows up in parentheses. Okay. Actually, let's move this out here. Next, we want to look at the temporary difference that's actually related to the difference between our CCA and our depreciation expense. So again, I'm going to take my depreciation expense, I'm going to subtract the CCA, and I'm going to multiply by the tax rate of 35% that was used. So when I do this, I get a result of 17,500. And when I add those together, I can see my adjustment for 65,500 is now broken down into the two components of what is a result of the change in the tax rate and what is because of the new temporary difference. So the last part of this is that we want to calculate our tax expense. And in order to do that, we start with our tax payable. Okay, so we calculated that up here at 105. So tax payable is actually a liability that is going to have a credit balance, right? We also have a deferred tax liability for 65,500. They are both credit balances, so we're going to add them together to get a result of 170,500. Okay, this is what we would record as our tax expense. The combination of our tax payable liability and our deferred income tax liability. So the next question that we're looking at is assignment 16-2, and we are looking at deferred tax balances. But now we're kind of trying to pull some of the pieces together that we did in the earlier questions. So up to this point, we've kind of been dealing with one temporary difference at a time. And now we are looking at differences that are created as a result of warranty work. And we have some developmental costs as well. So we are looking at this over a 4-year period. We want to look at what is the tax basis for development costs and the provision for warranty costs in each year. What is the accounting basis, the deferred tax balance, and is that balance an asset or a liability? So we really could stop here after the first 4 sets of columns, but we can carry it through and finish off the chart that we're used to completing. So just like we did in the technical review questions, we know that our developmental costs and our warranty liability actually have a 0 tax base to start with. Okay, what we are looking at is our accounting basis that's going to result in our temporary difference. So starting off with our developmental costs, we incurred 45,000 in 20x6, and we amortized 0. So our accounting basis is going to be the 45,000 that were incurred, and we would subtract what was amortized, but of course, being 0, the result is going to be the same. That is going to give me a temporary difference that I'm going to then multiply by our tax rate for 20x6. So keep in mind our tax rate is different in each year. It had an opening balance of 0. So my adjustment is going to be a credit and a deferred tax liability. Next, we can look at our warranty. So again, we are looking at the difference between what we accrued and what was incurred. Okay, so we're looking at the balance in that warranty liability account. So we incurred $22,500 worth of work, and we had $25,000 in that account, which means we are left with a credit balance of $2,500. And again, if it helps, you can use the sort of the T account approach to this. So we established the liability for $25,000. We then use up $22,500 of that, which leaves me a balance of $2,500 on the credit side, so it appears in parentheses. 0 minus my balance gives me my temporary difference, multiplied by 40% because that's my tax rate with a 0 opening balance. Okay, I see that difference of, or sorry, that adjustment of 1,000. So looking at the cumulative effect of this, I'm going to have a credit balance of $17,000 overall, which is going to represent a liability. Okay, again, the balance is on the credit side, which is indicated by it being in parentheses. So in 20X7, when we look at our developmental costs, lost my train of thought because there's little steps running up behind me. So our accounting basis was $45,000. Okay. In 20X7, we incurred another $50,000, but we amortized $9,000 of that, which is going to give me a balance of $86,000. Okay, so again, that was my previous balance. I added the $50,000 that was incurred, and I subtract the $9,000 that was amortized. Multiplied by my tax rate, which in year 2 was 38%. I had a previous balance. So my adjustment would be $14,680. Looking at my warranty liability, I'll do it with just a calculation for developmental costs and then break it down with the T account approach for warranty. So whatever approach works the best for you. So I had a previous credit balance of $2,500. We had $20,000 that was accrued. And then we had $17,500 that was incurred, so we would have removed that from that liability account. So my credits minus my debits is going to give me a balance of $5,000 on the credit side. Okay. That's going to create a temporary difference multiplied by my 0.38 tax rate. I had a previous balance, which means I need an adjustment of $900. In 20X8, I had a previous balance. I am going to add to that what was incurred. I'm going to subtract from that what was amortized, and it's going to give me a balance of $127,000. In year 3, my tax rate was 38% again. I had a previous balance. Okay. Looking at my warranty, I had a previous credit balance of $5,000. We accrued another $27,500. 30,000 of that was incurred and therefore moved from the liability account. Giving me a credit balance of $2,500. Tax rate was 38%. I had a previous balance. Developmental costs in 20X9, 127. We incurred another 25,000, but we amortized 25,000, so really that's going to net out, and my balance is going to be the same. My tax rate in that year, though, was 36%. I had a previous balance. My warranty had a credit balance of 2,500. We accrued another 40,000. Incurred another 27,500. My credits minus my debit gives me a credit balance of 15,000. Tax rate was 36%. I had a previous balance. Okay. So what we end up with here, because we're looking at the balance in this deferred tax liability, we have a credit balance of 45,720. We have a debit of 5,400, which of course is still going to leave me with a credit balance. So that overall deferred tax amount is going to be a liability amount. Okay. I'm actually going to pause this video here, come back and do the next 2 questions, just because I have to check on one thing really quickly. So there will be 3 videos in total for chapter 16.